All right, that's long enough. If they're not here by now, then tough on them. So, everybody, thank you very much for joining us. This is obviously the audit tactics and the IRS, how to be prepared for this upcoming tax season. And we have a special guest, a friend of ours, Garret Gregory, former IRS attorney, that is going to be sharing with us a ton of his knowledge. It does representation, has worked with probably some of you that are on the call. Actually, I know there's a couple of you that he's assisted through the audit process and had excellent results. So just kind of setting the framework for the rest of our session. This isn't audio only, so you're not missing anything if the screen's not moving. We've also expanded this and opened this up to not only RightWay community members, but those that are evaluating the RightWay product offering. And so thank you everybody for being here. Next housekeeping item is, on a webinar, we don't get to hear you, so it's kind of dead air. You're just listening to us talk. And really the way that we are able to hear your voice is through the questions section within the control panel. So if you have a question, go ahead and throw it in there, because we don't have a defined agenda of what we're going to talk about. I mean, we do know what we're talking about, but we're going to allow a lot of open opportunity for the Q&A portion. And so definitely fire away your questions. We hope this is highly beneficial. And at this point, would like to introduce you all to Garret Gregory. Garret, you there?
I am. Can you hear me okay?
I can hear you okay. Garrett's fighting through a cold, so we appreciate him pushing through and showing up and making this happen for us and sharing with us his experience and what he's seeing going on the front lines. If you would, Garret, would you just give like a super high speed flyover of your career and how you kind of got here?
Sure. Well, I graduated law school finished school in 2000. I got a law degree, kind of a regular law degree, and then I got a Master of Laws in Tax in 2000 from Boston University School of Law. And my first job was with PricewaterhouseCoopers in Silicon Valley, doing a lot of international tax planning work out there. And then in 2001, I joined the IRS's Office of the Chief Counsel, which is a fancy way of saying I was an attorney with the IRS. And I was an attorney with the IRS in the national office in Washington, D.C. for about 4 years, and then about 8 years in a field office in Dallas, Texas, where I handled litigation of both large and small cases. So, and then my wife, who has basically the same resume as I do, we decided we wanted to leave the government and start our own law practice so that we could actually help people and not just break more money into the giant void that is the U.S. Treasury Department. And so that happened roughly 6 years ago. So about she popped out about 6 months before I did, 5 or 6 months before I did. And then I left and joined her. And so we've been doing this on the good side of the fence for about 6 or so years. And one of our most prevalent types of cases that literally walked in the door when we opened our private practice was a tax return preparer. And it just so happened it was a due diligence examination, like many of you have gone through, and or maybe many of you are going through or about to go through. And we'll talk about that in a lot more detail in a minute. And so I've handled, at last rough estimate, we've handled approximately anywhere from 125 to 200 tax return preparer cases. That encompasses everything from the really scary side of the spectrum, criminal cases, to the less scary but still kind of scary spectrum, which would be the due diligence reviews or due diligence examinations, which are by far the most prevalent type of examination the IRS does. And so that's kind of who I am and how we got here. And like Jeremy said, we ran across these guys. I think they found us because they had some of their clients approaching them saying, gee, I'm getting this letter that sounds pretty scary from the IRS. What does that mean? Can you help us out? through the magic of Google and all that, they probably found us and kind of vetted us a little bit and hopefully interviewed us and kind of said, well, these guys sound like they know what they're talking about. Began referring some of their clients over as they had issues. And so it's been a pretty good relationship for the last however long it's been of kind of helping each other out on that front.
Yeah, just for clarity's sake, our relationship and establishing a relationship with the Gregory Law Group and Garrett and his wife was just out of necessity. We had clients calling us basically saying, hey guys, what do I do in this scenario? And we're not attorneys. We know our role. We know what we know. We know what we don't know. Most of the time we know what we don't know. And we reached out to somebody that was in the space that had the resume. And as this is not a Gregory Law Group infomercial, promise you all. This is allowing Garrett was willing, because of the relationship that we had, to share what he's seeing going on. So again, thanks Garrett for doing this. So you mentioned two types of cases or two types of things that pop up in an audit. You said there's criminal, and then there's more so the civil kind of penalties, or basically fines, or however you want to look at it. How do most, if you would just walk us through, and I think this is probably the most common question, or what people are thinking about, for those that haven't been audited and those that have been audited, what's the sequence of events that lead up to this? And then how's the whole process shake down? Somebody comes into their office, they want to see X, Y, and Z, and then this happens and so forth. What does that audit process look like?
Sure. Well, the most typical type of audit is a due diligence audit. When the IRS wants to make sure you as a tax return preparer are meeting your due diligence responsibilities as enumerated under our Internal Revenue Code section 6695G, as in giraffe. And you can read that and it'll put you to sleep quicker than NyQuil, but the regulations they're under. But what it's basically getting at is, as a return preparer, and particularly as a return preparer who prepares tax returns that contain the refundable credits, and you know what we're talking about: earned income tax credit, child tax credit, additional child tax credit, head of household status, which is new on the scene, and the AOTC, or the education credit. If you're preparing any returns that have those, any one or combination of those credits on there, you have to meet your quote-unquote due diligence responsibilities. And if you've been in this business for any length of time and you prepare, it's hard for us. Every year I get a little bit clearer picture of kind of what the sweet spot is. But if you start getting up over 200 returns, if you're an individual preparer, that seems to start putting in, and it's 200 returns that contain these refundable credits, then you are definitely on the radar in a big way. And the IRS, sooner or later, is probably going to send you a letter. That's the first contact. Now, they can just do what we call a knock and talk. They can literally show up, and sometimes they have a fun way of showing up right in smack dab in the middle of tax season. So right when you're blowing and going and trying to get all the returns done that you can, they can show up. We're finding they're doing less of that in more recent years. They're doing a more hands-off approach, which initially sounds like good news, but the bad news behind that is now they can do more of these audits because they're doing them remotely. And I'll talk a little bit more about that. But so usually the first order of contact is they're going to send you a letter, say, hey, John Doe, congratulations. We've selected you to audit your case files to make sure you're meeting your due diligence responsibilities, or something to that effect.
Winner, winner.
They'll say, so please give me a call by such and such date, and we're going to set up a time for an interview and for me to review some files of yours. Now, what we've seen, they experimented with last year and this year. These letters have already gone out, so I'm sure a bunch of you are on this call are maybe sitting there with this letter in your lap as we speak. I know they've started going out in the last week to 10 days because we've got a tremendous amount of calls on this very subject. So these letters are going out, just like I said, hey, we're going to come audit you and check to make sure you're meeting your due diligence responsibilities. And a lot of times they will have a list of 50 files right there in the letter. And they'll say, we give you until November 4th or November 7th or whenever, some date to send us all of your files that we have requested, all of these 50 files. If that's the case, that's what we call a correspondence audit, meaning this guy's never going to come to your office. We're never going to go to his office, but we are still going to do an interview. We're going to do about an hour to hour and a half interview where he's going to question you on your business practices, how you prepare returns. They may kind of quiz you a little bit on, hey, here's this situation. What would you do in this situation? Or how would you handle it? Or what kind of documentation would you request? And what happens if they don't send that documentation or provide that documentation to you? What do you do then, Mr. Preparer? And they kind of go back and forth with you for about an hour or so. And then at the conclusion of the interview, they'll say, okay, thank you for your time. I'm now going to go look at your files, and I'll be getting back to you. And usually what getting back to you means is you're going to receive what's called a revenue agent's report, which, the letter itself is pretty short, just a 1 or 2 pager. And then behind it comes our actual report, which will indicate, here's all the stuff you did wrong as a tax return preparer. Here's on a file by file basis. So we start with the Jane Doe file. Here's all the due diligence errors you made. And then we go to the next, the Sam Jones file. Here's all the errors you made on the Sam Jones file. And we go on down the list. And then, of course, we get sort of a culmination or a punchline at the bottom of the report says each violation is worth $520, and you had so many of these violations, so they do the math for you, and boom, there's your penalty. Have a nice day. We may get an exit interview with them where they kind of put a little bit more meat on the bones. Here's what I was looking at in your files. Here's what I didn't see that I wanted to see. Here's what I saw that I didn't want to see, whatever the case may be. But it really doesn't have any change on the result. And then there we are. We're left holding this report going, well, what do we do now? They're saying we owe them. In the typical range on these 50 files that we saw last year was in the $35 to $60,000-$70,000 range of a penalty. It's pretty typical. Now that the head of household has joined the party, I expect that range to go up a little bit, maybe more like 40 to 80, somewhere in there. But we'll just have to see. And so once you receive this report, another term for this report is called a 30-day letter. And it's called that because we have 30 days from the date of that report to file a formal protest contesting those penalties, at which point they will then take our case and move it into the jurisdiction of IRS appeals. We will be assigned an appeals officer, and we will then go forward and make our arguments to that appeals officer for why we think in these specific cases these penalties do not apply. And it's usually on some version of a case file by case file basis. And that's kind of how these cases, and then whatever happens in appeals happens. And you may be saying, well, gee, what if I want to go to court? Well, you can, but these are pre-assessed penalties. So it means you have to actually pay the penalty first, then file a claim for refund, which will be denied. And then that starts a 2-year clock. You have 2 years to file a complaint in U.S. District Court, which is an extremely lengthy, complicated, and expensive process because of jury trials, all the rules of formal federal evidence and pretrial activity apply, unlike tax court, which is a much more tax court is really court with training wheels on, but this is real big boy court, so no one wants to take these cases to that court. It's extremely expensive, and so it just doesn't make sense. You don't want to pay a lawyer $40,000 to go argue for $50,000 penalties. It doesn't really make any sense. So that's kind of where we are.
Yeah, just got a quick question because I think we covered on the correspondence audit, and then we touched on kind of the in-office. So the correspondence audit, the flow, the kind of the procedural flow would be, if you could just do a fast flyover of that again.
Oh, sure. The correspondence, you're going to get a letter. They're going to say, hey, call me by this date and send me these 50 files by that date. And so we have to call them by a certain date to set a time for our interview, but they're not, and they may wiggle a little bit on the timing for the interview, but they're not going to wiggle much, if at all, on the providing them copies of the files. Because of course they know what the game is. They don't want to give you any time to go back and doctor those files, start beefing them up with documentation, things like that. So they're going to give you a short, it's usually about a week, maybe 10 days to provide those files. They're not going to wiggle on that. So, and I had a case last year when this was brand new to all of us. We didn't even know this was coming, and they hit us with all this. I had a client who called me and I think retained me right after, or it may have been the same date that those files were due. Well, obviously they weren't delivered to this guy by that time. So literally by the time we had gotten everything scanned in and we're sending them off to the revenue agent, we were getting his report in the mail saying, well, you didn't give me anything, so I just went ahead and hit you with every penalty that can apply to all 50 files.
Guilty until proven innocent, huh?
100%. So they'll just hit you with everything and say, have a nice day, go to appeals, see what happens there. So they're not gonna wiggle a whole lot on that, because they're just going to assume if you need more time, you need more time to doctor the files.
Gotcha. So that's a correspondence audit, and then the in-office audit. Question was, do the files ever leave the office?
No, don't, and we would never let them leave the office. They will sit there in your office, meaning the revenue agent. That's the real big difference. The revenue agent, everything else is kind of the same. They want you to call in. We schedule a time. They're a little bit more gracious on providing extensions if we need them. But we'll set a time. They'll come out physically in person to do the interview. So they'll interview you in your office or wherever the files are kept. Because at the conclusion of the interview, they're going to say, great, here's a list of 25. And they're going to first give you a list of 25 files. And you're going to scurry off, grab those files, provide it to them, and they're going to sit there for a day or two or three looking through those 25 files. And at the end of that examination of those 25 files, if they find 4 or fewer due diligence violations, then they say, hey, I'm done here. No change, pat you on the back, you're doing a great job, keep up the good work. I've seen that done exactly once in my career. So don't get too excited about that as a possibility, even if your files look really good. Most likely what will happen is that they're going to get to the end of that 25, say, I found 5 or more violations, therefore here's another list of 25, please give me these, or I'll come back tomorrow and I'll give you my new list of 25. You'll get them the new list of 25, they'll sit there for another day or two reviewing those files, and then they sort of disappear and say, I'll be in touch when I'm done with my report. And 2, 3, 4 weeks down the road, we get a copy of their report, and then it's the same process from there on.
Beautiful. So I heard you right that you said exactly one time in all the cases and all the people that you've represented,
Right.
tax office owners, that has gotten the pat on the back, the well done, keep up the good work sort of scenario. No, and
Right.
I'm assuming in that scenario there was no penalties assessed.
Correct.
But
correct, and that's extremely rare. Yeah, every other the 150 some odd cases, there's a penalty that's coming down, and it's going to be in that range. Like I said, up through last year was in the sort of 35 to 75 range, and I expect it to go up a little bit this year because we just have a now 4th item that they can penalize, which is going to be replete in many of your files that are listing as head of household status. A ton of your returns are going to be claiming that status, so it's almost like the earned income tax credit. It's going to be prevalent in a lot of files.
So how long do they have to go back on a tax office and start auditing? Because I know there's kind of we're dealing with the federal government, so they're not Johnny on the spot with things, and they may flag you for 1 year or a following year, or what's the statute of limitations and how does that work?
Right. Well, they can go back 3 years very easily. We're finding they used to do that. The old days were good in some respects and bad in some respects. They were bad from the standpoint of there was no file limitation. They would come in and, I use an example. I had a client in Texas once that got audited, 800 files got audited, and they pretty much hit them with a penalty on everything. So it was a complete nightmare. We used to see penalties in the hundreds of thousands of dollars. The good news now is they've limited themselves to 50 files. Not to take it easy on us, but more so just to be more efficient so they can hit more return preparers. But that's kind of a good news situation. Also good news, they're really not going back. We're not seeing that anymore. It's been a couple of years. Really, they're auditing either the current, they tried that 1 year. They came in the middle and were trying to audit real-time tax files. which was, I mean, that was just kind of an unholy mess, and they haven't tried it since. So I think they figured out that was kind of stupid. So what they're doing, and their tactic this year is interesting, and it's a repeat of what they did a couple of years ago. They came out right before tax season to audit the previous tax season. So that's what they're looking at. All the calls we're getting right now is to audit the 2017 returns that were prepared last tax season. And what they did a couple of years ago, which I have to assume they're probably up to here, is they can hurry up and audit return preparers now, right before this coming up tax season. That way they can ding them and they can say, here's all the things you're doing wrong. So now you've been put on notice. So we go through this next tax season and they can circle back around to you. And if they see the same things happening in your files or the same lacking documentation or Q&A or things of that nature that they've identified during this audit, then they can really hit you hard, and they can include in their report, hey, we were just out there a few months ago. We just warned them. We just went through all this, and they just thumb their nose at the government yet again. It's kind of a setup. And we saw that a couple of years ago, and this has a little, I don't know this to be the case, but this has some of that feel to it again this year.
Gotcha. So in terms of the penalties being assessed, is the business owner, because I would imagine that the majority of people on this call are the actual owners of the office as opposed to preparers within the office. Typically, how do the fines roll? Do they go to the preparer because they did it on their P10? Do they roll up to the office owner, or do they just fine everybody and say, let's see how much money we can get? That was actually a question, right, Cam Min, that I put some pizzazz on. So
sure. Well, and it's a good question, and it's another thing that's really varied in their tactics. Well, just to be clear, let's get some definitions right. If you're the owner of a tax office and you employ tax return preparers, even if you never darken the doorway of one of your offices and never sit down at the computer with a customer and bring out a tax return, you are a return preparer by definition, under the code. Okay. So they can, the whole host of tax return preparer penalties can apply to you. And I've had this happen, and I have tax owners saying, I don't even know how to prepare a tax return. I just own the business. I'm the big picture guy. I, write the checks and keep the lights on and rent the space and just make sure everything's operating, but I don't prepare returns. And I've had to explain to them and point it out. Here it is in 7701A36 or something like that of the code. That's where it defines tax return preparer, and you're in there as the employer. So, it's open season on you just as it is on the guys that are actually hitting the keys on the computer keyboard. Okay, so you're just as much prepared as they are. Now, having said that, I did have a couple instances last year where they at least explored applying it to the owner, what I refer to as the ERO, the owner of the office, not the actual boots on the ground tax return preparer. They have difficulty doing that. The IRS has some issues with doing that, just the way the law is written. It makes it hard, because there are some knowledge requirements and things of that nature. And if you really are the owner, then it's going to be hard for them to get it to stick on you. But I will say they'll try, and they're not going to reward you for your ignorance either. So the goal isn't to kind of turn your back and be as hands-off as you possibly can. I would say the opposite, in particular when it comes to like training your return preparers. If I'm representing a business owner, I always like to see how we've got training manuals. We've got online training courses that we actually made our return preparers do and earn a certificate through, stuff like that. That's the stuff that really drives a wedge between, I hate to say it, but between you and your preparers. Then if your preparers sort of sleep through all that training or don't pay attention or don't implement it, and they go off and prepare returns that should never be prepared and don't properly paper the file, then it's going to be on them, because if the IRS then says, well, gee, owner, what did you do to keep this all from happening? You say, well, gee, I made him get this training certificate. Here's a manual. They can always, here's a reference, kind of a desk reference. They can always reference with any questions. Maybe we have an office manager they can always go to with any questions they have. So they had resources. Whether or not they chose to use them, it ultimately is on them. In situations like that, the IRS will most likely kind of quarantine their examination to just the preparer and not try to go up the hill. If they find that the
I was going to say, I had on that same exact topic. I had one of our RightWay community members had an audit and explained to the individual, the auditor, that yes, they had EITC training. They actually, as a group and individually as preparers, went through the online training. And the auditor said, well, how do I know you actually did that? And he said, show me the roster. When did they come in and sign in, as if like an attendance sheet? When did they sign in? How do I know they were being paid? She ended up, I mean, there's kind of a he said, she said in that scenario, because she could show him the payroll, but there was no defined, hey, we're meeting on this date to discuss these topics and so forth, and here's the preparer's signature. And he didn't believe her.
Right. So that's a good lesson to learn. Everything you do, document. Yes, you're doing this to actually train your people and make them better at what they do, which is ultimately going to help you as the owner. But let's be real, you're also doing a lot of this as CYA. You're covering your backside. So you want to memorialize and document everything for this purpose. So when the IRS comes in and they look at you and say, hey, Mr. and Mrs. Owner, what have you done to subvert this or keep your people from just, ushering taxpayers into the U.S. Treasury and grabbing money and running out the back door? And you want to be able to show them you're providing this training. You're meeting your due diligence as an owner is a way to look at it. You're giving them the tools they need to properly meet their due diligence requirements, or at least be educated on what those are. And then if they fail, it's on them. But yeah, to your point, Jeremy, yeah, if you do provide training or anything like that, we want to be able to show it. So it's not just you're making stuff up and, oh yeah, we had all these seminars and all this kind of stuff. But yeah, whatever it is, roster shot, take a picture with your phone, everybody waving, hey, training 2019, what a great day, something goofy like that. But that all becomes stuff that stuff we put in the file that builds up, and we show that to the revenue agent. Eventually they'll say, okay, well, it looks like you did your job as the owner, so we'll just focus on the preparers.
So something that's coming in, and I think it's just kind of an interesting point, is the IRS doesn't tell everybody what they need to retain as due diligence, right? They give us the form 8867, and then you are supposed to then build out your own additional set of questions and guess in terms of what paperwork needs to be retained. Like if we were, just for an instance, let's just say we're EITC and they're questioning the legitimacy of a dependent on the return, whether it be a non-standard dependent or a standard dependent. What would you need in that file for you to do your job and punch the examiner, in the figurative nose?
Right. Yeah. Well, the best. Yeah. Well, take a step back. Yeah. The people who are sending in this question or this comment are 100% right. The IRS, and I beat this. There's two things I beat to death. One is you as tax return preparers are the number one target of the IRS. You'll hear me say that a million times. You'll also hear me say the IRS does a terrible job of sort of illuminating where the bright lines are in this test. What's a good file? What's a bad file? What's good documentation? What's bad documentation? They really do a crummy job. And even some of the materials, if you go into IRS.gov and look at it, they're incomplete, they're confusing, and I've even found inconsistencies. They're contradictions. I've seen them say, go left on one document on there, and I've seen, no, go right on another document. It's dealing with the same situation. So it's kind of ridiculous, and they have some hokey videos that are out there that are just absurd. It's just, there's a real void coming from the guys who are actually enforcing the rules, which is, bad. It's bad enough if some training group or some education center doesn't get it right or help you guys out. But when the guys that actually make the rules and then enforce the rules, it can't really illuminate them, then it's a real problem. And then add to that the fact that the IRS has no clue, and I know some of you have been through this, when they come out and examine you and your files and start talking about situations in your files, well, gee, don't you think it's weird that this lady is taking care of her kids and her sister's kids? Well, they don't know the community that you're serving here. And it's woefully naive. The IRS kind of thinks everybody makes $50,000 to $75,000 a year at a W-2 job, and their kids go to school, and everybody comes home and eats dinner together, and it's great. They don't understand what's going on in a lot of the communities where refundable credit type returns are being produced. So you get a huge disconnect of knowledge and sort of understanding of how the world works on this side of the tracks taking place at the IRS. So all that to be a long loop around to, the simple answer is there is no answer. There is no such thing as a perfect file. I mean, there just isn't. What the IRS basically is going to put back on me all the time and you guys is the expectation that, hey, you're charging people a fee to prepare a tax return. So that means you are a professional tax return preparer. And just like a guy who's getting paid to play basketball as a professional basketball player, you would expect him to make a layup. So they kind of would assume, well, these due diligence rules, these are like a layup for a professional basketball player. And since you're a professional return preparer, hey, this is just a minimum that we should expect of you. And it's, how the rule reads, to grossly paraphrase it, is you're supposed to act as a reasonable and well-informed tax return preparer would, given the situation before you. And so if that situation is, okay, I've got Tina Jones sitting in front of me and she claims she takes care of this kid whose last name is Smith. Okay, well, what documentation do we have? Do we have something that links her? Is she claiming the mother? Okay, if she's the mother, do we have a birth certificate that says her name and it says the kid's name? Okay, well, that's good. That links us relationship-wise, but we're not done there. It's a two-part test. There's a relationship and a residency test. So just because she's mom doesn't mean she's providing more than half of the economic support for this child. And that's usually accomplished by showing residency. So what can we show for that? Oh, I don't know, dental records, any kind of medical records or school records, something that shows kid's name and mom's address. Now, great. Now we've linked it. This is mom, this is kid, and kid, at least according to the school or the doctor or somebody, lives at that address. So at that point, I'll take that case file into appeals all day long. I'll win 100 out of 100 of those.
That's just insane, though, the level of subjectivity as it relates to the material, and then how deep you end up having to go in order to, as you referred to earlier, CYA. I mean,
right.
If somebody came in and asked me to prove that I'm my kid's, father on the street, make sure that I wasn't, kidnapping them or something, other than our appearance, I have no idea where to even go to source that information or, have on hand. That's
right. I mean, and the IRS will, they'll readily admit, hey, you don't have to do an audit. You're not there. We're not charging you with it. You don't have to audit your customers, but you do have to identify these QC, these questionable circumstances, and then either gather documentation or ask additional questions and get answers that clarify what's going on. So documents are always the top of the mountain. If we can get documents that connect all the dots, that's always the best, because no one's going to have to believe us. These are documents. Okay. If we're in light of having any documentation, then we have to really go deep in the question and answer with the customer as they're sitting there. Well, how do we know? Why do they have a different last name? Oh, they took their dad's last name, and he and I were never married, so I never had his name. They took the dad's last name. That's why his last name. How do we know that dad doesn't take care of them or something? Oh, we haven't seen dad in a long time. He ran off. We haven't seen him in forever. It's just all we need to start getting. It's personal, and I get that from a lot of my clients. I'm explaining to them just like I am to you guys right now. I'm saying, here's kind of the questions, here's the depth. We kind of need to hammer on some stuff. And I get a lot of shootbacks, like they're going to look at me like, man, why are you asking me these questions? These are kind of personal. I don't really like talking about the stuff. And in addition, to make it even worse, sometimes my client, the tax return preparer, will know these people and have known them for 10 years and maybe cousins or something like that. And they'll say, well, I'm going to get a lot of feedback like, why are you asking? You know the drill. I'm your cousin. You know what the situation is. And it's like, well, I understand that, but this is to cover my rear end and yours. Because, if we don't do a good job on this return, they're going to audit you just like they're going to audit me. And so that's kind of what I tell my clients is, let them understand this is for their own good too. Because if we don't do it, if we half-ass this, I'm going to get in trouble and you're going to lose, all of your credit and get to pay that back to the IRS. So none of this, nobody wins if we don't do a good job on this stuff.
So if you've been doing, is there something like, I know I walk into the bank and they don't require me to give them my ID anymore because it's like a known customer transaction. If you've been working with a customer for a long period of time and they're a known customer, do I still need to gather the same, bunch of paperwork each and every year and ask the same questions, or will prior year information suffice current year, or is it just kind of
you've got to unfortunately start every year as if you have amnesia and anybody you've met before then you forgot. You really do, and you have to start over. Now, what I tell some of my clients, some of the documents that don't ever change, birth certificates don't change, Social Security cards don't change. If you want to keep those in the file and show them and say, hey, John Doe, I know you've been coming to me for 8 years. Are these still valid? Are these still, accurate copies of your, whatever it is you're showing them? And he says, yeah, that's all still fine. Okay, you can make a new copy of that and put it in this year's file. I've got no problem with that. And if you want to run through, say, questionnaires from a previous year, still married to Martha, still have the 2 kids. Oh, gee, they're getting old. I guess they're 16 and 15 now. All that kind of stuff. Yeah, sure, you can do that, but you still have to gather all that information. You have to go over that. We can't assume that he still has custody of his nephew or niece, or he's still taking care of his disabled sister. Things are, he still has the same address. I mean, we need to start over with all of the clients on some level, which I know is cumbersome and ridiculous, but it's just the way it is. And the IRS does, there's actually, there's a one court case that kind of touches on 6695G, these penalties, and it specifically states prior or personal knowledge of a client does not count to meet due diligence. Now, I argue it all the time in appeals because I know no one knows about this case, and I'm right, but so I still get some leverage out of it, but I shouldn't, to be honest with you. But until they slam that door, I'm going to keep driving a truck through it. So I always make that argument because many of you, I'm sure on this call, many of my clients are from small towns, or even if you're from a larger town, the community you operate in and do returns for is small. And so a lot of your people. Maybe you've been doing this for 5 or 10 years, so you've got a lot of repeat customers. So you have a lot of built up knowledge of these people. You're kind of in their lives. You know what they're about and like what their scene looks like. But you just kind of almost have to ignore that. Can almost hurt you in this context. You have to sort of shove that out of your brain and re-interview them each year as though you don't know them, and ask these probing questions and document this information, even though you may already know it. It doesn't matter what's up in your brain, it's what's in the file. So we've got to get from brain into file and make sure that's there so that if and when the IRS shows up and they open up these files, you don't have to say, oh, wait, I know there's not much in there, but here, let me tell you all the stuff I know about your client. That doesn't work. It's too late at that point. So we need brain on paper.
That'd be good for me, just operating from that perspective, because I can't remember anything to begin with.
Sure. Yeah, as we get older,
that's my wife.
Things happen.
That's my wife. She says I can't remember anything. So that's so lame. I don't know how else to put it. That they want you to, and I like the way you phrased that, enter every season as if you had amnesia. I mean, that's just a great sort of, I don't know, visual metaphor, if you will. So now that there was something we had talked about previous with, and I don't know the circumstances around it, but you said that there were a number of cases that you had been working with regard to preparers being enjoined,
Right.
the ability for them to even participate. I know that I've got customers that have 2 or 3 offices, 4 offices that had a rogue preparer that they were the manager of the office, or one of their multi-offices of their organization was just not performing as they should. And that office then subsequently got the remainder of the offices shut down and their EFIN privileges and e-services privileges revoked. I mean, is that a scenario that you've worked on, and how do those typically transpire?
Yeah, definitely do. What's funny is we're used to, up until really probably about 4 to 6 months ago, I would have told you, yeah, they're called injunction examinations, and it's just real quick, forget these penalties, which are bad enough. This is where they come out and say, okay, Mr. EFIN holder, we think what you are doing or what's coming out of your offices from a tax return perspective is so bad and so damaging. We're going to skip right past due diligence. Forget that. We're assuming you're not meeting due diligence requirements. We're going to explore whether or not we need to just shut you down, meaning enjoin, which is a fancy legal word for to stop. Okay, so if you're enjoined or there's an injunction, you are prohibited from doing something going forward. And you will be prohibited by a U.S. District Court judge. So if you were to keep doing it, you would then be held in criminal contempt of court, and you go to jail for a while. So that's not good. And so they'll strip you of your EFIN, and basically what happens, usually it's a lifetime ban. Sometimes they'll just do a suspension, but for the most part, if they're going for an injunction, it's a permanent injunction. It's forever. So you can never file tax returns. It also usually spreads out to your spouse, your siblings, your parents, and your children as well, because they know if they don't do that, then I'll just operate my business through my spouse or through, my brother or mom or daughter or something like that. So they just kind of wipe out the whole family. I mean, it can be that crazy. And I used to see 1 or 2 of these a year. It was pretty rare because it has to be some pretty bad fact. This year alone, and they've definitely done them timing-wise different than the due diligence, which are really rolling out right now. But I caught about 4 to 6 of these. I think it was 6 of them, just 6 of them over the summer, basically. So they are definitely ratcheting up not only the number of audits they're doing on the due diligence side, that's why they're doing these correspondence exams on the due diligence side. So one revenue agent can now do maybe 5 or 10 of these instead of 2 or 3 of them, like in years past. But they're also increasing the intensity of the examination. So number of audits from the due diligence side, but for example, if they've hit you a couple of times with due diligence audits, it's not unlikely that they will come out and say, okay, we've hit you with due diligence enough. Now we're going to start turning up the heat and saying, if we've hit you with due diligence a few times and you still haven't figured it out, then maybe you need to be enjoined. And so, and I actually got confirmation of that from an appeals officer. I said, well, my sense is that you guys or the IRS is kind of turning up the heat. And she basically said, well, yeah, what we've heard is the due diligence isn't working as effectively as we'd like, meaning to put you out of business. So, they're going to turn up the heat and go for more injunctions, because then it just resolves the matter for once and for all. So that's a real scary sort of prognostication coming from the IRS, that they're going to start doing more of those audits. Those are much longer tail, much bigger in scope. They don't look at as many files, but what's at stake is really, is a lot more gloom and doom than what we're dealing with on the due diligence side. Good news is, to enjoin you, the IRS has a pretty high burden of proof. It's basically the burden of proof right up to the line of criminal. It's not a criminal case. I want to be very clear with that. It's not criminal, but the burden on the government is basically fraud. They have to show that you willfully and recklessly acted in such a way to reduce taxes for your customers. And so, they've got a pretty high mountain to climb. Every client I've ever represented, knock on wood and hope this continues to be the case, we've avoided the injunction. Now, as a fallback, if you don't get enjoined, they still have a whole plethora of penalties they can apply, including due diligence, but even more onerous penalties than that. For example, there is an aiding and abetting, which is $1,000 a file. There is a willful and reckless which is similar to the injunction standard itself, but it's a penalty that imposes a similar standard, and that is a $5,000 penalty per file. So they've got still pretty big arrows in the quiver, but we'd always be much happier with a big penalty than shutting down the whole operation forever. That's always a better result. But I've never had a client be enjoined that I've represented. We've always been able to kind of argue the case back onto the penalty side of things and get it out of the injunction crosshairs. So that's where it is at this point anyway. And the other thing that's scary, if you get enjoined and you can Google these, tax return preparer injunctions, and a bunch of orders from the court you'll see them. These things written by the judge, and they're pretty damaging. I mean, they say, we're enjoining him because of X, Y, Z, and he was intentionally doing this, he was recklessly doing that, he knowingly did this. And to me, as an attorney, I'm reading these things going, gee, these are basically criminal indictments. It's the same verbiage we see on criminal stuff. So it's always been my position, you've got to fight these really, really hard, because if you allow an injunction to go through and that document's out there, if the IRS decides to initiate a criminal examination against you, 99% of the work is done. They've already gotten a district court judge to say, all these things, and it's official, it's in the book. So you're right up against that line as it is. So that's always kind of a scary thing. All we do in my firm is federal tax law. That's all we do. We do tax return preparer representation, of course, is a big chunk of that. But we do regular audits. We do collections cases. We do some tax opinion letters, things of that nature. A very small segment of our firm is we will do tax criminal cases. And we maybe get 2 of these a year, because I don't really hold myself out there. I don't want to. Those cases can be very overwhelming. They can just sort of take over my whole practice. So, I don't really hold myself out. If they find me, fine, I'll take on the case. But every case I've had that's a tax criminal case, except for one, involved tax return preparers. Okay, so not to scare you, but I guess to scare you. It is, again, even on the criminal side, not just the civil side. I'll say it yet again. You are the biggest target of the IRS, and that includes, unfortunately, not just civil penalties, stuff like that. That's bad enough, but even on the criminal side. Now, it takes a lot to get there, which is a good news. They've got to show a lot of bad behavior on your part or your return preparer's part. But it's just something I will note.
Interesting. Very interesting. So we got a couple of questions. If a preparer has been fined/penalized, how can he or she resolve the penalty? And another question, can a preparer make payment arrangements or do an offer and compromise depending on the amount of the fine? So if a preparer has been penalized, so they've already gotten whacked, they already did the examination. I remember there's something with regard, obviously you already made mention of the 30-day window to appeal. Is there anything that can be done after the fact? Like that, let's say that 30-day window is closed and you've signed some documentation basically acknowledging the fine. How does that transpire at the end? You get whacked with a penalty, and what happens?
Okay, well, if we're still interested in fighting the actual penalty itself, and I've had this happen, and last year was it's kind of another big year for this. Folks would come in and hire me after that 30-day. They'd gone through the due diligence examination, they'd gotten the report. The 30 days had come and gone, and so now they got collection letters saying, "Hey, by the way, you owe us $52,000 or whatever it is," and then they would call me and say, "Hey, what can I do?" I said, "Well, let's try." The good news is you never got appeal rights. Bad news is it was kind of your own fault. You didn't read the documentation or you didn't respond in time. But we've been pretty successful in shoehorning these cases kind of back into the flow and getting our chance at appeals. And it's usually me whining and begging and moaning and doing whatever I can do. And eventually they want to shut me up. So, okay, fine. We'll give you a crack at appeals. And that's very, very valuable, because in appeals, it's not like the good old days. The good old days where the penalties were hundreds of thousands, and I would usually argue them down to $5,000. We're not seeing those types of results anymore, but we are getting them cut down a good chunk, usually. A lot depends on the files. There's a lot of factors go into that, so I'm not making some blanket guarantee that, hey, we're going to cut everything in half. It's not necessarily the case. It really depends on each case individually. But by and large, we have a pretty good track record of getting these penalties reduced. And so it's worth, if we can get back into appeals and take our shot, it's definitely worth doing whatever we can to do that and reduce the penalty amount, at its source. But then, assuming we're past that, and we've argued and we've got to reduce as much as we're going to do, then it becomes formally assessed by the IRS, and it's just a regular old collections case, just like if you owed income tax or anything else. So now all the menu of options are available to us. Yeah, if you really can't pay it, if it's a big enough penalty and you just don't have the assets or the income to ever be able to pay this off, or within the 10-year collection statute window. Bear in mind, when the IRS makes an assessment against you of a penalty or a tax, they have 10 years from the date of that assessment to collect it. And on midnight of the 10th year, whatever you owe goes away. They write it off. So there's a bunch of rules that go along with that. There's some things they can do to prolong that, but by and large, that's the general rule. They have 10 years to collect it, or it gets written off. If we can show that you're just really in a bad way financially and are never going to be able to pay that off, then we can back into some other calculation of what you will be able to afford, and we offer that in compromise of the total amount owed. Now, if you are doing pretty well with your tax return prep businesses and maybe some other things you do, and you only owe the IRS 30, 40, 50 grand, more likely than not, you're going to be too pretty financially to successfully make an offer and have it accepted. So the other options become working out an installment agreement. And typically, again, depending on some things, we can negotiate out a 72-month or 6-year installment agreement to pay this off. So even at $50,000, an installment agreement over 72 months, roughly going to be $650, $700 a month. So not great, but at least that makes it a lot more manageable. In other words, they're not going to show up and hold you upside down and shake you until you pay the amount due.
So I've got a theory on, it's entirely a theory at this point, which is, do you think there's any correspondence between reject rates, meaning you submit a file, and then you have to submit it again, it gets rejected back, and the percentage, that kind of percentage calculation of the total number of files submitted and the number of times in total submission, then you come up with your reject rate. And that kind of ties into another thought of the W-2 verification and paycheck stubs, people filing on the paycheck stubs and the inaccuracies as it relates to withholdings or elected deferrals or whatever's the inaccuracies of the W-2, kind of those things just kind of compounding, because in the tax business with the banks basically incentivizing now, because you can start offering the pre-act loans, which I don't know if you know this or not, Garrett. The banks are now doing a loan on your anticipated refund starting January 2nd prior to an IRS acknowledgement, which kind of incentivizes you to do the whole paycheck stub thing. And if your competitor down the street is doing it, the official rule is don't flip and do it. Like, it's not worth it. You're going to get whacked.
Yeah, not no, but hell no.
Yeah, not no, but yeah. And that also the Social Security Administration, the IRS, are working incredibly close, verifying these W-2s on pretty much a real-time basis. So that whole paycheck stub thing is either going to, if it doesn't generate an audit, it's going to generate a delay in filing, or a delay in the refund, delay in you getting paid, or it even may kick up a verify to where your customer has to go in and verify their identity prior to getting their funds released, in which case it generally gets paid to them and we're all hosed. We all lose in that scenario. And right. I just rambled on to the original question, which was, do you think reject rates or inaccurate W-2s, even if they're slightly off by, $100 in withholdings or whatnot, would kind of create a scoring model to once you get to 100 here, then we're gonna tag you.
Yeah, there's no question, and we saw a more profound direct correlation between reject rates. I would say, I think it was a year or two ago. That was a common thread with almost all of my return preparer clients for that period of time. I think the IRS is getting more sophisticated now. And let me take a step back and say there are no accidents here. Okay? You, as a return preparer, you have not been selected at random. This is not the lottery system at all. They very intentionally picked you. The 50 files that they're going to come out, whether they send it to you in the mail to Correspondents Audit, or whether they show up with their 2 lists of 25, there is nothing random about that. They're absolutely selected on purpose. I know that for a fact. And so I think that back in the darker, the dark ages, something like reject rate was a real easy thing for the IRS to pounce on. And I think now they don't even have to rely on that. I think they're going in, so they can do so much with algorithms. They key into the computer. They can look up your P10, and if they associate certain tax returns that have certain amounts or lines populated on a Schedule C, for example, or certain numbers of Schedule Cs that report a certain amount of income or loss, or even more impressively, they'll relate what the impact. So what's the final result of a Schedule C? What does that do to the overall income on the tax return with respect to maximizing EITC? Because I've seen these reports. That's pretty damaging stuff when they show, well, we did a little report, and of your clients' 250 returns, 240 of them have have Schedule Cs, and 232 of those, the Schedule C is what enabled the tax return or the taxpayer to get the maximum EITC. Uh-oh, that's not good. That's these are very bad statistics, because it's showing that whatever we're using the Schedule C, for example, here as a tool to manipulate income either up or down to maximize EITC. So they're now tracking stuff to that level, and we didn't see anything like that a couple of years ago. Nothing like that level of sophistication. And so, I'll always be a couple, at least 1, if not 2 years behind, because I only see what the IRS is up to, a year after they've implemented it and the audits come. So my information versus what the IRS obviously knows they're up to is going to be at least a year old, because I don't see it until those audits kind of work their way, percolate up to the top, and I get hired, and I work the audit, and I sort of see what they've got on their side. But all that to say, Jeremy, there are no accidents. All this is very intentional. It doesn't mean they're right. Okay, it doesn't mean just because you've been flagged, just because you have some statistics or some benchmarks or triggers that send up the flares and say, we got to go, Susan Jones, we got to go audit this preparer because we're seeing all these criteria being met. That doesn't mean Susan Jones is doing anything wrong. We get out to her office, we look at the files. Hey, these are great files. Everything's done right. And that also doesn't mean that all of Susan Jones's clients are above board and telling her the truth and providing accurate information on their, side business that they do and the status of their qualifying dependents. If her clients happen to be really good liars and really good manipulators, but if they have documentation and they provide the right answers, and Susan Jones has done her due diligence, then Susan Jones has done her job, even though her customers may be scumbags that are lying, cheating, and stealing the system. But at that point, Susan has done her job. Now it's up to the IRS to go get the bad guys. That's not our job as return preparers. We don't have to audit them. We don't have to jump up and down and call the IRS when they're in our office lying to us or anything like that. If they provide us the documents we request that validate their story and the information they're giving us, we've done our job. So
that's a good
just because you're flagged
right there, Garrett.
Hey, I'm trying.
That is such a good defense. My customer lied to me. Go get them. That's right.
Go get them. There it is.
Go get them.
So
it will be. Heck yeah, it happens.
Oh, it absolutely does. It absolutely does. Well, I've had this conversation with multiple people in the IRS. Look, everybody kind of knows what the game is. Most of the clients that will come into, everyone who's listening on this broadcast, every one of the clients that's going to come in, or a huge number of them, they probably know the numbers of how to position themselves in the sweet spot of the earned income tax credit better than you and your preparers do. Okay, so they're coming in, and the IRS knows it. The IRS, just for them to go after each one of these individuals, which is only $4,000, $5,000, $6,000, versus going after one preparer that will hopefully scare off 50 to 100, maybe 200 customers, kind of scare them straight through the process and wipe out a preparer. And maybe we get a $50,000 or $75,000 penalty on top of all that. It's just much more efficient for them to go after the preparers. I mean, they know that the majority of our procurement preparers are really trying to do things the right way. It's
RightWay,
just hard.
Way to do that. Way to work that in there, Garrett.
Yes.
Try to do things the right way.
Oh, RightWay, yeah, branding. There you go.
Thank you.
The correct way. The correct way. I don't want to get into any copyright issues.
You got it the right way the first time. You got it the right way.
But yeah, they understand that, but it's still it's the system. They're going to come after you guys much more than they're going to go after the individual taxpayers. It's just more economical for them to do so.
All right. So question as far as contemporaneous notes. If you're taking notes during your taxpayer interview, we had somebody basically said they got fined by an examiner because they didn't have the notes written down, handwritten. They were digitally entered into notes within the system. And they said, no, that's not going to work. What is there probably isn't an official position, but from your standpoint, if you had to argue this in front of an appeals court or whoever it is you're talking to figure this out, if it was in their computer system and they're able to print it out versus if it's being handwritten at the same time as the interview is happening with the taxpayer, does it matter?
Well, what if you don't have hands and you can't write? That would be Americans with Disabilities Act violation.
There you go. Oh, now we can sue them for discrimination.
Yeah. You can get it. Let's go. But no, there's absolutely no. Your revenue agent in that situation is all wet. If they're saying they have to be handwritten, that's absurd. That's ridiculous. Now, what I have seen, and this is a temptation in digitally maintained notes. If I were you guys, if I was a return preparer, I would do everything digitally because I can type a heck of a lot better than I can write, and I can type faster, and I can actually read it when I go back the next day to read it. So I would do everything. Plus, I just hate files. I mean, I run my whole law practice. I don't have a single file, in my whole practice. We do everything digitally. So I barely even pick up a pen on a daily basis. But now, what we have seen get some of our customers in trouble, and this is where I have to be. This happened in a case with a client. It happened several times, and in one case with a recurring client. And we have these lengthy. When people hire me, what I always say is, yeah, you're hiring me to fight this penalty, but probably the more valuable piece of this is me kind of educating you on where your files are and what we need to do to get them where they need to be, so we can really have a much stronger position before the IRS and IRS appeals. And that educational component through the engagement is really far more valuable than, yes, of course, we're going to try and fight this penalty, avoid it, and if it does hit us, reduce it in appeals and all that good stuff. But more valuable is the knowledge you'll get, so that moving forward, you'll save yourself a whole lot more money than just this one penalty going forward. And so I working with this client, take a lot of notes, put them in the digital. It's right there. It's easy. You're in the software anyway. Type it right in there. Ask him these questions. Put them in there. He's like, okay, yeah, that sounds great. Well, he gets picked up on audit. I think it was a couple of years later, and he calls me up saying, I got it again. So let's hire you again and do it. Okay, fine. I get his file. One of the first things I notice, I look in the notes, and there are notes. Initially, I'm ecstatic. I'm like, he's a good student. He figured it out. He put notes in there. As I went file by file, I started noticing it's the same paragraph. I mean, like to the word. So what he was doing was cutting and pasting the exact same notes over and over again. That's not going to work. And he even did it kind of to the extent to where it didn't even make sense for a client. I mean, he may have referenced two dependents, in this case had three or something like. I mean, it was just really obvious that he cut and pasted it. And the IRS will glom onto that because they have in every case I've had like that. They've glommed onto it and they make a big issue of it. They don't want to see that kind of stuff because that just shows, okay, you're learning a little bit to try to pass muster, but you're not putting any thought into it. You're not evaluating. You're not really asking this taxpayer any questions. You've got a canned paragraph that you just throw in all the notes sections. So no, that's not what I mean when I say take notes. Okay, it's really, you're going to have to spend time with these taxpayers and ask them questions. And there is no one set of questions. There is no magical questionnaire. I have a questionnaire I've developed over the years that I've shared with my clients. It's like a 9 or a 10-page questionnaire. It's a behemoth. It's a mod, but even that, I'm quick to tell everybody, this isn't it. I mean, this won't guarantee you anything. Because if you got a guy that comes in with a particularly weird set of circumstances, you're going to have to ask some questions that aren't contemplated on any preordained or pre-made list. You've got to really listen and respond with additional questions, requesting additional documents, additional information, things like that. So, sorry, but to scale it back, no, there should be no difference between handwritten notes and digital notes. And that, I would love to take that case to appeals because that revenue agent's a moron if they're saying that.
Yeah. Well,
that's just wrong.
Actually, his name's Pete, and he'll be calling you. Is what he said here in the thing. So that's literally okay. I will be calling him.
There you go.
There you go. Well, I guess it is an infomercial at this point. Yeah, that's the level of subjectivity. I mean, if I owned a tax office, I would literally have my preparer due diligence masters that anything outside of this scope of type of return, they've got non-standard dependents, they've got a business, they check all of these boxes. That file now needs to get moved from, newbie, hired in November, trained in December, went to work in January, to somebody that's been doing this for a long time and has the history. Just like I wouldn't let a new tax return preparer handle my Schedule CEF, sort of clientele that have more of a complex scenario. I would move that on up to make sure that that we're checking all the boxes, and as you referred to it, CYA. It's just good practice.
Yeah, and I'll do one other plug just to highlight an area we've seen a lot of lately, and it's to your point, Jeremy. You have to have someone working on these returns that has perspective, enough experience to be able to. Because what I see with a lot of younger or new guys in the business, 1, 2, 3 years in, they'll pay a lot of attention, and maybe rightly so, to a specific thing or a specific area of the return. Okay, fine, that all looks great, but they have no sort of big picture vantage point. So I've had sort of a rash of clients where that have just gone through appeals here just recently, and it's made my job a little tough trying to argue for it. We've got, grandma here taking care of grandkids, and she makes, say, $24,000, $2,000 a month of Social Security, and she has a little side business. She does some baking. She makes cakes for people and stuff like that. Okay, well, that looks good enough until we look at the Schedule C. And I remember one particular instance, I think she was making $24,000 a year in Social Security. She was claiming a $14,000 a year loss on the side business.
Yeah, yeah, throwing the flag. Blowing my whistle, throwing the flag.
Yeah, we can have businesses that lose $14,000. Not unusual. They're all over the place, and sure, it's legit. But a woman on Social Security taking care of 2 grandkids that only makes $24,000 a year cannot suffer a $14,000 loss. And I even went back and looked at the prior 2 years tax returns, hoping maybe that would throw me a lifeline, like she had made a profit. No, it was the same thing. It was almost the exact same deal. So, in that situation, that's where a return preparer needs to be able to back up, really do the 5, I call it a 30-second scan. You should be able to look at the front 2 pages of a 1040 and know real quick where your problems are or if you're all clear. You should be able to compare a few numbers here and there. How many credits do we have? What are our dependents? Who are these dependents? Are they siblings? Are they disabled? Are they 30 years old? Or is it a spouse? Do they have the same last name or not? what's their income? Do we have Schedule C? Do we have wages? You know, you should be able to just rifle through these little bits of information about 30 seconds and know if we got a problem, if we at least pass the initial smell test. And if we don't, because, oh, wait a minute, $14,000 loss, $24,000 of income, that should be right there. Whoa, wait a minute, Miss Jones. Before I hit, you know, the e-file button on this, how are we living with a $14,000 loss? She's probably going to get flustered and get up and leave. Good, because we don't need her as a client anymore, because she's just going to cost you routinely anywhere from $520 to $2,000.
That's not revenue. That's a liability.
Yeah, absolutely.
Yep. So we are past our hour. I would just say we've had questions coming in with regards to how do I save this within the software? How do I support my business model? This is what I'm doing. I've got remote preparers doing this, and you know, I've got 10 remote preparers out here working, and they're transmitting their own tax returns. Well, we need to talk immediately. If you guys are trying to differentiate your business model and trying to take things outside of the four walls of the traditional tax prep environment, you've got to take a look. The internet solves a lot of problems for everybody, right? We have an online software platform that will give you complete control and visibility to make certain that people are not sending out tax returns without you having put your hands, your eyes, checking all the documentation, because we have a digital document archive built in the software. There's an approval process built into it and a workflow to where you can approve a return, or you can fail a return and tell them why you then failed the return. And it's all built in there automatically within the online platform. So that's our only RightWay plug. And now we've got questions as far as what does typically this sort of representation cost? And then at what point should they engage with you? Should they engage with you pre IRS examination? Should they engage with you once they get their penalty letter? And then what's the dollar figure typically associated with it?
Okay. Well, it's kind of a range. I do a flat fee. We do that for a couple of reasons. I hate looking, you know, most attorneys charge a retainer and then bill hourly. And I did that up until about 2 years ago, but I just found I was looking at my watch more than I was practicing law. And that's never good, just too much back office stuff. So I've been doing this long enough. I know what my time investment's going to be. So I just went to a flat fee. So my typical flat fee is $6,000 for representation and that's really true of any audit, whether it's a tax return preparer, 1040 audit, or and then it can go down if it's a really small case, or, you know, I try to service even people that only owe the IRS 25 grand or something like that. We can do something custom, but $6 grand is usually kind of my starting point. And another reason for doing the flat fees is because I think a lot of clients were saying, ooh, let me wait, because I don't want to run up a bunch of fees now. I'll wait and just hire them at the end, and it'll be cheaper. So I just wanted to take that off the table. So it's not any cheaper to wait until the end and hire me than it is to get me at the beginning. So, and I would much rather get cases, and it's much better for you if I get your case as far upstream as possible, because then I get more familiar with you, your files, how your business practices are. And I'm going to be a far greater benefit to you in walking you through maybe some changes we need to implement, some things you need to do differently from obtaining documents, what documents to ask for, how to retain them, questions to ask, all that kind of stuff. The longer you and I are kind of tied at the hip through the process, the more it's just going to be kind of second nature to you. Not like it is to me. At this point of looking through returns, I can literally look at a tax return in probably 10 seconds, and I can tell you exactly what the problem is going to be, or what the IRS is going to glom onto. And it's not because I'm the Doogie Howser of, you know, tax audits or anything like that. It's just I've seen so many of these that you know, once you've seen a million of them, it just becomes the back of your hand. So, you know, if I can get you to that spot, you know, then that's where you want to be certainly as a tax office owner, as a tax preparer yourself. So that's, you know, hopefully that kind of answers that question.
So on a IRS due diligence audit, because that's a federal agency and you can represent tax office owners or preparers anywhere in the country, correct?
Correct. Yeah, last count, we've got clients in 24 states and 7 foreign countries. So we've kind of got them, and that's on tax return preparers necessarily, but that's a huge chunk of I'm a Texas-based lawyer, but I also live probably 75, 80% of my time is in Florida. And then the rest is chasing my kid around playing baseball. So I'm kind of all over the place. So yeah, I've got clients all over. Since it's federal law, it doesn't matter.
What about if somebody's getting hammered by their state, they're being jerks about something?
Probably I'm not the guy you want to call. You'd want someone else that's familiar with, and I couldn't represent like in Illinois if Illinois revenue is jumping up and down, which I've got a client where that's happening. I've got a bunch of clients in California and in New York. And those are the 3 most aggressive states, California, Illinois, and New York. If it's part of another federal case I'm already working on, I'll sort of throw my hat in and deal with them a little bit. But if it's a primary or an exclusively state issue, yeah, you don't want me. You want a local guy that knows those rules better than I do.
And I know that I have clients that have improperly employee classification with respect to, they tried to say that everybody was a independent contractor, when in reality they had hours, they had a company email, they were using a company computer, they weren't submitting invoices to the tax office for payment, which is do you ever handle employee classification issues?
Yeah, tons of those. The IRS made that an area of emphasis about a year and a half ago. It had been otherwise laying dormant for 20, 25 years. As a matter of fact, the first case I teed up to go to litigation on as a field attorney in Dallas, the first one was a revenue agent named Rob Wolf, who's a really smart guy. We had teed up this employee classification issue, and boy, we were ready, and we trotted it into my manager's office, and he looked at me, he's kind of an older guy with the glasses on the end of his nose, and he kind of looked at me over the top of his butt and said, we don't waste our time with those paltry cases. Go find me something juicier. So I was summarily dismissed. So that shows the IRS really ignored those for decades, and then they figured out, all of the CPAs of the world have figured that out and are telling all of their clients that own businesses, just make everybody, including like the secretary and the receptionist and the rank and file employees, just make them all contractors. Then you can, of course, get out of paying their share of the employment taxes. Now, so out of nowhere, the IRS sent like 5,000 revenue agents to training about a year and a half or two ago. And I actually found out about that because you call me up and say, cancel because there was some training. And after about the third agent told me this, I said, gee, what do y'all get trained on? What's going on? I said, we're all being mandatorily trained on employee reclassification because we're going to all pick up those cases again. And I said, oh, God. Here we go. And sure enough, if you come under audit, now we're way outside the scope of tax return preparer stuff. If you just come under audit on the 1040 side or your business return, a mandatory question on the first information document request, IDR, which is the first document they sent out as part of an audit, one of the first questions will be, who's your employees, who's your contractors, please show me copies of any employment or contractor agreements you have in place. So they now have to make that part of any audit that occurs of any business or self-employed individual. So it's a big, and I know a lot of these tax offices treat everybody as contractors, and there's a motivation to do that. There's many motivations to do that, but just know that that's going to be scrutinized, or that very much can be scrutinized.
So just something putting out there, if you're running a large tax office organization and you have a bunch of preparers, classification of your employees as independent contractors or employees is something that you should definitely brush up on, and make sure that if you are classifying somebody as an independent contractor, they are in fact independent contractors by the IRS standards. Just because you pay them on a 1099 basis doesn't make them an independent contractor. If you're setting their hours, they're working in your building using your machinery and equipment to get the job done, they're not submitting to you an invoice for payment. More than likely, I would say that most people paying their employees as contractors are probably in the gray, to where that
Right.
that typically.
Yeah, that's a nice way of putting it. You're being very generous.
I am.
Yeah, if we're going to dabble in this place of calling people contractors, then at the very least we need to kind of arm ourselves and at least get contractor agreements in place, maybe tweak or change our practices as much as the owner. You know, I'm doing this right now, not a tax prep office at all, but I've got a big client, big employer. It's a big business, speaking of the hell, partially in Chicago and partially in Texas. And they've got a whole bunch of whatever you want to call workers. Let's call them workers. You know, they had called everybody contractors. And they want to go now, and they sort of found a religion, and they want to do it right. So I'm going to them and drafting them up contractor agreements, and I'm trying to work with them. Okay, to get this person to be a contractor, you've got to give them control of what they do. I mean, like they're a real contractor. It's like the guy you hired to do your roof. You're not up there examining every shingle he nails in. You're trusting him because you don't know what the heck you're doing, and you don't want to fall off your roof and break your neck. So get on up there and go do it. It's the same kind of way. And all of a sudden my business owner, well, I can't let this guy handle all my marketing, my company, without telling him what to do. And I say, well, congratulations, you just hired your first employee. I mean, he's not a contractor then. I mean, there's no way. So it's a sometimes painful process to bring, you know, employers or business owners into a level of understanding of really where that line is between contractor and employee. Like I said, we can paper it up and we can put some armor on, but if the IRS comes in, you can't agree to status. So just because you and this guy shook hands, hey, he wants to be a contractor, I'm just doing what he wants. The IRS doesn't care. They don't care about what you want. They don't care about what your worker wants. They don't care about the contract that's in place, although that helps. They're going to really dig underneath and say, okay, well, what does this guy do? How does he do it? What are his hours? Does he wear a uniform? Does he use your equipment? Does he show up? You know, all that kind of, it's a 20-factor test. To talk about really absurd. They're going to examine 20 separate factors to ultimately come to their determination of how to classify this worker. And I will just say, just like the IRS agents are very liberal in applying penalties to tax return preparers, they are equally, you know, and maybe even more so, as liberal as classifying workers as employees rather than contractors.
If they're trying to bring Uber under scrutiny as it relates to this, which is, I mean, by every standard, I can't imagine that they would be employees as opposed to actual contractors, being that they clock in when they want, they use their own equipment. I mean, right. Then we definitely need as tax business owners to take a look at our practices as well. We are coming up on, we're coming up on an hour and a half. The questions have been awesome. The level of engagement we've had at this point has been awesome. Hopefully you guys basically just understand the overall process of these audits and how they're going to proceed and how to better equip yourself. I wouldn't even say not to get fined, because as we've stated before, the criteria is subjective and there isn't really a standardization to where you can make sure that you've dotted all your I's and crossed all your T's. It's really, how do you put yourself in a defensible position that if you do get audited, you have enough ammunition for somebody like Garrett and his team to use on your behalf to help get you out of the scenario. Obviously, we would love that the auditor comes in, checks your files, and says, congratulations, here's a gold star, continue, we won't talk again. It's just not a likely scenario. And so, hate to be the bearer of bad news, but we'd rather you be prepared than this come as a shock. And part of being prepared is making sure that in the event that this does happen, part of our budget as a company, we have attorneys. We have an attorney bucket where we shove money so that when something does pop up, we have the resources to properly represent ourselves. Not that we've done anything wrong, but our business is in California, and we're the most lawsuit happy state in the country, whether it be from ADA compliance to just employee rights, and we're all for, we treat our people very well. Our team will tell you they love working here, but you know, opening a business is a giant liability, and you guys have taken an amazing step, but it definitely arm yourself with the proper materials to represent yourself in these audits, and have a rainy day. We'll call it the Gregory Fund. Would that work for you, Garrett?
Yeah, sure. That sounds perfectly fine.
So on your balance sheet, your P&L, go ahead and just label it Gregory Fund in the event of an audit. We are at an hour and a half. Thank you, everybody. We have gotten a number of questions as far as, hey, I chimed in a little late. Can I get this later? Yes, we don't have a slide deck for this because this was really supposed to be organic, driven by attendee questions and participation. So at the conclusion of this, we'll upload the video to our to YouTube, and then we're going to blast out this link, the link to it. So thank you, everybody, for being in attendance. There's a couple of you. I have some follow-up actions to where we'll be jumping on the phone here. As you can see, Garrett's company website is right there, gregorytaxlaw.com. And Garrett, just wanted to say thank you, and we appreciate your time, your expertise, and hope you feel better, man. Thank you for soldiering on.
I appreciate it. And anytime, I always enjoy talking on this subject to people that are trying to do it the right way.
Awesome. Nice. I like the way you incorporated that.
Yeah,
right at the end.
I thought you'd like that.
And thank you. 2 brownie buttons for you. So that's going to conclude everything. Thank you, everybody, for attending. We appreciate your time. For those of you that are working with us, thank you. And this is for you guys. For those of you that aren't part of the RightWay community, this is just some of what you can expect as far as how we add value to our community. So thank you very much, and that will conclude today's webinar. Have a great one.